Let me get my microphone. Hey, Mike.
Hey.
Okay, we will get started here for the May Director's Cut. Just want to point out real quick that there is an error in a couple of the things on the Director's Cut that one of them has been corrected, and you can see that reflected on the screen here, and it's also been corrected on the website. The total production for April was actually listed as May's figure. So we've got that corrected, and then also the all-time high for gas was actually in March of 2016. So my apologies for not catching that. And again, let's try to keep questions to the topics on the webinar and on the Director's Cut. Those are my ground rules. Other than that, I will turn it over to Mr. Helms.
Thanks, Allison, and thanks everyone for logging on or tuning in to the July production update, the May Director's Cut. I've labeled this month's production, or May's production, resistance training. That was a big fad not too long ago. In fact, you can still buy resistance bands, I think, and exercise equipment that uses resistance bands. And as I thought about what I saw in the numbers, that kept coming to mind. You look at oil production, and you can see that oil production actually bounced back up, not quite 6,000 barrels a day, a little over 5,500 barrels per day. And that just shows the resistance of an enormous industry or machine like North Dakota oil production to even low rig counts and low completion counts, which we certainly saw. There is so much inertia when you're at or around 1 million barrels a day that production typically doesn't drop real rapidly. We saw in April an abnormally large drop, and then we recovered some of that in May. So there's resistance to production going down, and I think we should look for that same kind of resistance on the other side. It would appear, based on completion numbers, rig count, oil prices, that we've hit bottom, and we're kind of bouncing along bottom. But as we see better oil prices and we see completions, and even when we start to see some rigs coming back, there's going to be resistance to production increases as well. And it's going to be difficult to lift production higher, just like it's been difficult for it to decline. We saw that in the gas production. Gas production increased April to May. Crude price has increased a little bit, but there's a lot of resistance in the world markets to crude price increases. About a year ago, we had the Iran deal that nobody anticipated actually getting signed, and that resulted in the second lower leg of the oil price collapse. And then just as we thought, oil prices had recovered to above $50 a barrel, and maybe we could start that 90-day clock ticking. We got to Brexit, and the value of the dollar changed versus all the other world currencies. It has rippled through the entire world economy and has even resulted in some more slowing of Chinese and India demand growth. And so here we are, kind of stuck in the mid to upper 40s, and there's a real resistance to climbing out of that $40 to $45 a barrel range, which we really have got to get above $50 a barrel before we see significant work on fracking non-completed wells. We are in that price range that allows industry to economically work on the idle well count, and we're seeing some of that. Rig count, again, very resistant to increases. We've seen a couple of rigs added and then one taken away and back and forth. But even today, less than 30 rigs working, 29 rigs working today. As you move through the numbers and commenting again, oil price resistance, completions are kind of stuck in that upper 30s, lower 40s per month number, and that's not enough well completions to increase production. In fact, it's not really enough to maintain production. So it points to a gradual decline in production, again, by the fourth quarter of this year, probably dropping below 1 million barrels a day. The count of wells not completed is up again in May, 931 wells not completed. The count of inactive wells up again, but folks out in the oil patch tell me that there are significant numbers of calls for workover rigs. People working in the convenience stores out there tell me that there's workover rig crews coming in. There's some FR clothing being sold, and so there are wells being put back on production and well repairs being made. Even in the flaring resistance, we saw flaring percentage increase back about 10%. We popped back up to about 11.5%. We saw the daily volume flared increase by almost 41 million a day. And so there again, we're experiencing resistance in holding those numbers down and dropping those numbers down. By the end of the year, we anticipate 3 more gas plants coming on stream. And so we will improve our ability to hold those flaring numbers down. But when we start to see significant production increases, it's going to be difficult to keep the flaring percentages down. You probably saw in the federal category that continues to expand. The newest and latest thing is the U.S. Fish and Wildlife Service releasing its guidance on how it's going to manage drilling of non-federal minerals. And so we're going through that document. It's almost a 400-page document looking at were they responsive at all to Industrial Commission comments, and that may be one of the things that we need to take legal action on. Again, I spent several days last week in Washington, D.C., talking to Congress about our difficulties in this area, and I think you see some of that reflected in the bill that Representative Kramer got attached to appropriations in terms of providing some resistance to the increase in federal regulation. So we are evaluating whether we need to intervene in the lawsuit that's been filed over the sage grouse. We have determined, or the Industrial Commission determined on June 29th, that it's going to submit comments on the EPA information collection efforts under methane reduction on existing sources. The Industrial Commission did decide it's going to file a petition for review of the EPA methane reduction rules on new and modified sources. Mr. Kramer included waters of the U.S. and also this latest U.S. Fish and Wildlife thing, which we're reviewing at this point in time. So again, we are just really kind of stuck in these interesting times. There's an ancient Chinese curse that says, may you live in interesting times. And we certainly are. Every time it appears that we're going to get the price increases that would result in increased activity and increased production, something new comes along, like the Brexit, which is a pretty big surprise and leaves us in the upper 40s in terms of oil price, just kind of on the same course. I'll take questions.
Okay. Question about production in general. Doesn't the May production figure show more of a stabilization or an uptick in crude oil output as a sort of recovery from February's 13-year lows? If so, why do you still expect a gradual decline in state production?
All right, that's a multi-pronged question. So, yeah, I think May, on the face of it, the numbers look like a recovery. I think what you're actually seeing is that April was such a terrible month. In April, we had the normal production decline. We had the continuous wind, which blocked us, industry, from completing wells for the majority of the month, and we had road restrictions in place. And so April was probably twice as large a decline as it should have been. Had April been a normal decline of 20 to 30,000 barrels a day, May would have been a decline as well. So I wouldn't consider May a recovery unless May production had been up more than 35,000 barrels a day, and it wasn't. It was up not quite 6,000 barrels a day. So it was a continuation of the trend, just not as many pieces of bad news as April. We are not seeing enough well completions to sustain production. I believe in May we had 41 wells completed, And that is in the neighborhood of half as many as what we need to sustain or maybe slightly grow production. And so if we continue along that trend of 35 to 45, maybe even 50 wells a month being completed, production will decline slowly. It cannot increase at those numbers. It takes probably 60 drilling rigs and 80 or more wells completed every month in order to grow production.
Do you still anticipate production? Do you anticipate production dropping below 1 million barrels by the end of the year? Do you think it will reach as low as, I believe it's 900,000 is what the advisory, revenue advisory group said? Do you think it'll get that low?
The question in the conference room was, I stated that I still anticipate oil production dropping below 1 million barrels a day by the end of the year, and I certainly do. I think the fourth quarter of this year, if not then very early next year, will be below 1 million barrels a day. The Revenue Advisory Group picked 900,000 barrels a day. That looks like it's a conservative number, like it would be the very bottom of this trough. And so I'm hopeful that we don't get that low, but I don't want to count it out. As I said, there just seems to be one thing after another that provides resistance to that $50 oil price that we need for well completions. And unless we can see some significant world economy recovery or a decline in the value of the dollar, we're just not getting there.
Go ahead, Dave.
So if you could do a little further explanation why flaring up.
Yes, thank you. The question was a little more explanation on why did we see an increase in flaring. There are really two factors here. The first being that natural gas production went up and there was no additional processing or gathering capacity ready to take that up. The Hawkeye project for Hess has really stalled that, and you see that in the numbers that I presented there. The Tioga Gas Plant operating at 74% of capacity. They have been counting on their river crossing under Lake Sakakawea in order to bring that plant up to full capacity, and it just is continually delayed and delayed and delayed, the approvals for that. It looks like it's still going to get approved in time to build that project before the end of the year, but those two factors together, increased gas production in that area, and that's really the only area where there's active drilling and completions is northeastern McKenzie County. So we had increased gas production in that area and no place for it to go because the Hawkeye transfer pipe under Lake Sakakawea still has not been approved and put in service. Still hopeful that will happen before the end of this year.
And the operators of the two other gas plants that are expected to come online this year?
The operators of there are actually 3 gas plants slated to come on by the end of this year. One Oak with the Bear Creek plant, Oasis with the Wild Basin plant, which is just kind of across the highway from Garden Creek, so it's just northeast of Watford City. And then it hasn't really been advertised or announced very much, but Liberty Resources is building a 50 million a day gas plant northwest of Tioga to process in the area that they've been drilling in.
Okay.
So that should help significantly.
A question about the Brexit.
The what?
The Brexit? Did I say that right?
Okay.
I think that's the first time I had to say that loud.
Brexit at Tiffany's.
Yes. Is the impact entirely just on global price, or are there any positive or negative long-lasting impacts that it could have on North Dakota production?
The real impact of Brexit is all about world oil prices. The UK is not a market for Bakken crude oil, but the initial short-term impact is that the dollar really increased tremendously in value. The pound dropped, the Canadian dollar dropped, basically every currency associated with the British Commonwealth dropped. And the dollar, I loved what Neil Fisher with the Wheat Commission said last week. He was asked about the dollar and its effect on commodity prices. and he referred to it as the cleanest dirty shirt in the drawer. No world currency is very good right now, but the dollar is the best that we have, and it increased quite markedly with comparison to all of the British Commonwealth currencies. That means the long-term impact, we've talked quite a bit about India as the next China, and India truly is poised to replace China as the place for crude oil demand growth. But India is a British Commonwealth country, and so there could be long-term impacts of the Brexit that linger and hang on and affect world crude prices longer than this whole exit from the EU could be impacting them.
So the workover rigs, even though they're completing wells, that's not enough to keep up with production. But what does that mean for jobs in the western half of the state? Is that helping, I guess, boost job numbers out there?
Yeah, the question was workover rigs and well repairs and job numbers. So workover rigs help stabilize production, and we've seen significant activity there. I was in Williston last weekend, and I was happy to see that the two workover rig yards that I drove by, there were less rigs in the yard and more out in the field. I actually saw some rigs out in the field with tubing and rods standing in them, so that was encouraging. Unfortunately, those wells that they're putting back on production average only about 30 barrels of oil a day, maybe 30 to 50. So you have to put a lot of those kind of wells on to affect production. So it is a stabilizing force. But you're right about the fact that it really creates jobs and economic activity that can drive sales tax revenues for the state in western North Dakota. A workover rig requires 5 people to keep it operating. They work 12-hour shifts, and sometimes they need 2 crews, because if they're doing a clean out or something like that, they'll run 24 hours. And so it will appear that we've added 100 or more workover rigs, which means that we've added 500 to 700 jobs. Every one of those people needs a hard hat and some FR clothing and some boots, and they spend money as rapidly as they make it. So it is going to be a boost to the Western economy through the jobs and through the sales tax revenue. It's not going to have a big impact on oil production, except to slow the decline to some extent.
Dave, go ahead.
Back on natural gas, was it the Energy Information Administration, the EIA, reported that prices seem to be climbing now as we get into the summer season with the hot weather and more electricity being generated from natural gas. What could be the effect on North Dakota natural gas prices?
Yeah, so the question was, in the natural gas arena, prices and the effect in North Dakota. And there's several things going on there. You're absolutely right. Natural gas used to be a high winter prices, low summer prices commodity. But because of all the shift to gas-fired electric generation in order to feed the air conditioners across the South, and we have had very hot weather again across the South in the United States, we saw natural gas storage volumes decrease from 35% above the 5-year average to about 23%. So there's been a big draw on natural gas in storage. That has really helped the price. We saw a significant, over a 50-cent increase in price, and that is truly benefiting these folks who are building the new gas plants. About that same time is when Liberty Resources looked at the economics and saw that it was truly economic for them to go ahead and build their own plant and make sure that their natural gas got processed and put into the system. So it's going to help us tremendously in sustaining this build out of gathering and processing to have those high summer gas prices. And yeah, you can actually see it in North Dakota investment with Liberty Resources announcement.
Do you think because of the BLM fracking rule, the EPA rule that's proposed, do you think there are actually any producers out there that aren't drilling because of federal regulatory uncertainty?
I don't think it's a major factor in North Dakota, federal regulatory uncertainty, although, as you have seen, we have languished at 0 rigs on Dakota Prairie Grasslands acreage for many months. And so they're drilling only whatever is necessary. But North Dakota is a relatively low federal mineral, federal surface state. Where we see a lot of that happening is in Wyoming and Colorado, where they have and in Utah, where the percentage that federal minerals and federal surface state is very, very high. The net effect of that, there is an effect on North Dakota, and that is it makes room in the market for our crude oil and natural gas. So it helps in terms of decreasing domestic production and hastening the production increase, but again, I don't see a lot of that in North Dakota.
And do you want to remind folks what our percentage typically is of the federal minerals?
Yes, just as a reminder, federal surface and minerals in North Dakota is about 8%, but in terms of productive acreage, it represents more than 3 times that. It's about 27% of our oil and gas productive acreage, simply because that's all situated in the West. And so even though we're less than 10% federal surface and minerals in the state, it's all in the West where the oil fields are. So it has more than 3 times the effect of what the numbers would say.
Okay, I don't see any more questions from the webinar. So if there are no further questions from the conference room, we will switch gears and let Justin get that.
Just to close, I want to thank Congressman Kramer for his work. We've spent quite a bit of time talking to Congress about the impact of these rules and submitting comments on these rules, and it's nice to have Congress respond with some action to help North Dakota along the path that we've laid out.
Okay, we are up to
There we go. Okay, perfect. Well, good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. Just want to get started here with the usual fashion. I'll take a look at production around the U.S. Williston Basin. Again, eastern Montana, South Dakota, continuing to slide in their production, as well as the updates as you just heard from Lynn. So again, overall, from the U.S. Williston Basin, from a transportation needs perspective, we're seeing production declines continue in the neighboring states as well. When I looked at the estimated mode of transportation out of the region, there was some shifting between the April and May numbers. We're continuing to see pipelines and pipeline and refining be the bulk of the transportation and processing mode for the Bakken crude oil, with 33% now estimated to be leaving the region by rail car. The big shift, you'll see it here in just a few moments, we saw a significant shift in barrels being trucked up into Canada in the month of May. And I'll touch on that here in a moment. And so those barrels that do get trucked into Canada, they still ultimately end up on a pipeline system there. To my knowledge, I don't believe that they're going up to get on a rail system, but rather for marketing reasons being moved into Canada to be moved on a pipeline system. And so you'll notice on the very bottom, that green, a pretty significant uptick in the month of May. And then the blue, which would be the pipeline movement, going down, but in reality, it's just kind of a wash between whether that barrel got on a North Dakota pipeline system or on a Canadian pipeline system. Continued declines in the estimated volume of crude by rail out of the region. Again, under 400,000 barrels a day estimated to be leaving the region by rail car. When we look at where that crude is heading, we've seen some continual shifts in market share. You'll notice PAD 1, which is in green, which is the east coast of the U.S., losing market share to the west coast, which is that blue line that you see trending upwards here in the last year or so. It may, by looking at the market share, seem that maybe volumes are growing to the west coast, but in reality, when we look at the hard numbers from the federal government, you see PAD 1 and pad 5 on the chart on slide 7. Pad 5 is actually a little bit lower than some of their highs, so they're not increasing volumes to the west coast. However, they're not decreasing at the rate that the east coast is receiving crude from North Dakota. So again, pad 1, east coast, pad 5, west coast continue to be the main destinations for crude by rail out of the state. Pricing around the region, again, strongest on the east coast, pad 1, followed by the west coast, and then pad 3 and pad 2, which is the Gulf and the Midwest, at least in the most current month of April, trending very closely. Typically, we'll see higher prices in that pad 3 region, the Gulf, than the Midwest, but because of market fundamentals in April, we were seeing those more hand in hand, which has not been very common, at least in the recent history. We look at pricing today, just under $2 spread between Brent and WTI. Again, that's indicating to me not a real major shift to be expected in the near term with how oil is being moved and marketed out of North Dakota. Slide 10, this is what I was alluding to earlier, that significant shift in the barrels being trucked in and out of North Dakota across the Canadian border. Month of May, again, I just got these numbers and put these together, so I haven't had a lot of time to investigate, but what springs to my head right away in May was when the forest fires up in Fort McMurray started to occur, and so I don't know if there were some marketing reasons, supply constraints, potentially on the Canadian side where potentially North Dakota oil was being moved north for purposes of marketing in their system versus what may have been filled by more traditional Canadian crude coming south out of Alberta. Looking at the natural gas, you heard from Lynn, the 11% flaring, again breaking that down, staying at 2% from April to May of gas that's being flared from wells that simply don't have a pipeline connection. We saw the gas flaring increase in that orange slice of the pie. So again, those are wells that are connected to pipelines, they just don't have enough pipeline capacity. And so when we start looking at why the flaring increased or where it increased in wells that were already connected, and so just again, production was higher than what those systems could handle. And more good news on slide 12 as far as gas connections. So again, the pace of new wells getting connected to gas gathering systems has been outpacing month over month now for quite some time, the pace of drilling, which again helps work on any backlog of wells that were drilled previously that did not get connected at that time. So again, it's a good situation when the gas gatherers are connecting wells faster than producers are bringing them online. One thing I'm going to just start touching on, I think, going forward, we talk about each month crude oil and natural gas. One set of commodities I think that get missed, and I think I'm going to focus on a little bit more here going forward, are natural gas liquids. And so there was a question earlier about natural gas prices. At the wellhead in North Dakota, a significant portion of the value of North Dakota's natural gas is contained in these natural gas liquids. And so if you're not familiar with natural gas liquids, those are your ethanes, propanes, butanes, natural gasolines, and so those come to the surface with the crude oil in the form of natural gas. At our gas processing plants, which you see on slide 14, this is the volume of those natural gas liquids coming out of these plants. And so this is another set of commodities that I work with and track, trying to figure out how they're moved, where they're being produced, what the trends look like going forward. And so we can expect maybe a little bit more attention as well on these commodities because the volumes have been growing significantly, and we expect some very substantial growth long-term in natural gas liquids out of the region. So I don't want to skip those each month in telling the story what's happening there as well. So with that, I'd be glad to answer any questions.
First question from the webinar is any explanation as far as why crude by rail to the East Coast has fallen so dramatically?
So as far as, other than just a generic answer of market conditions, again, that Bakken barrel is having to compete with waterborne barrels that are coming from overseas, and so those refineries, those marketers, will take a look at, again, what they can purchase a Bakken barrel at, what it costs to transport it, and what they can get a waterborne barrel for. And market conditions right now are such that those refineries on the East Coast, as well as in general, are choosing alternative sources rather than crude by rail.
Any idea if the oil delivered by truck shipments to Canada was likely refined in the U.S. or if it was refined in Canadian refineries?
I don't have any way of tracking what happens to that barrel after it gets into the Canadian system. It's leaving the U.S. Williston, or the Canadian Williston Basin by pipeline, where it ultimately ends up at that point. We don't have any way of tracking that. It likely comes back into the U.S. on the Enbridge mainline system, but that system also has the capabilities now of moving crude oil back into Canada through the Great Lakes region. And so where that barrel ultimately ends up, we don't have a way of telling.
Any idea where the demand for increased natural gas liquids comes from?
So that's the big question right now. These natural gas liquids that are produced, the Bakken is not unique in this. The other natural gas plays, the other shale plays around the U.S., there's been significant growth in natural gas liquids production across the U.S. and Canada. And so folks are looking at where those barrels are most needed. We're in discussions and looking at opportunities even in North Dakota for using some of those natural gas liquids for value-added processes. So, right now, the big user is going to be in the Gulf, which is the big petrochemical users as the industry sits today. But again, folks are looking at what's that next phase. Are there more opportunities long-term for places like North Dakota for those liquids?
What is the status of the Badlands NGL plant?
As far as I know, the last I'd heard was at the Williston Basin Petroleum Conference as far as any type of update, and I don't know if they've put any type of timeline or any concrete plans around it.
How are the NGLs being shipped? Are they trucked or piped?
So it's a combination of primarily piped, and so a significant volume is sent down the One Oak Bakken NGL line, which goes down to Wyoming and then further east into Kansas, where those natural gas liquids get processed. Significant amount of our natural gas liquids that aren't even reflected on slide 14 are left in the dry gas stream, and so that ethane primarily is being burned in communities like Bismarck, other users of that natural gas. And so there's a significant amount of natural gas liquids that, because the value is not as strong as it was several years ago, the ethane primarily gets rejected. It gets sent out as dry gas and just burned as a regular natural gas stream. We do have barrels that get trucked regionally, primarily propane, the Midwest being a big user in the wintertime. They'll store it in the summer, ship it out, and then get it used. We do have some rail of natural gas liquids out of the region, not real significant volumes compared to crude oil, but that is another mode of transportation.
Question? Okay. If there's nothing else, I don't have anything else on the webinar.
Thank you very much.
Okay. Thanks, everyone. Have a good weekend.
Could you just